In this video, we're going to look at McGrath Rent Corp. And this company rents and sells modular buildings, storage containers, electronic test equipment, and much more. And what I do in my videos is I run my discounted cash flow model to see the value of a company's stock. And then I look at the financial ratios of that company, and I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $1.55 billion. And then let's see what they're trading at. They're trading at $63.10, so that's one share of stock. And the way you value a company is you estimate the future free cash flows, and then you discount that back to today's value. And that's what I'm doing in this video. And the best way to estimate the future free cash flows is to get their actual free cash flows, which is what I just input into the model. Now I'm going to get the net income, which is the profit and loss on the income statement. And that's also going into the model. And then I'm going to pull the revenue, which are the sales for each year. And every year the sales are increasing. You can see in 2017, 18, and 19, their free cash flow was less than their net income. I like to always check to see why that is. This is the cash flow statement from their 10K. And the way you calculate free cash flow is you first start with net income. So you can see in 2019, they had $97 million of net income right here, which is right here on top. So you always start with net income, and then you add back the non-cash items. So depreciation and amortization is on the income statement, but that's a non-cash item, so that has to be added back. So you can see the $187 million right here is the cash provided by operating activities, which is greater than their net income. So that's what you expect to see. So to calculate free cash flow, you just take the cash flow from operations, it's $188 million, and you minus out any purchase of equipment. And they purchased $167 million of rental equipment and $12 million of PP&E. This company not only sells equipment, but it also rents it out. So that's why the rental equipment is here, because it's going to be depreciated over a long period of time. If they bought equipment and just sold it to customers, it wouldn't be on a cash flow statement. It would just all be on the income statement. So 2019 makes sense why free cash flow is less than net income, because the company invested in their business and they bought a lot of equipment. Same thing with 2018. You can see their net income was $79 million. Cash flow from operations is $142 million, which makes sense. You would expect that to be higher. So when you take the $142 million and minus out these two numbers, the $123 million and the $15 million, you get the free cash flow of $4 million, which is right here. And that's why it's less than the net income, because they invested in their business in 2018. 2017 is a little different. They had net income of $153 million, but their cash from operating activities decreased. It didn't increase as we expected. It went down to $122 million. And the reason it decreased, there's a lot of things going on here, but the main reason it looks like was this deferred income taxes of negative $96 million. In prior years, deferred income taxes increased their cash amount. In 2018, it increased to $12 million. In 2019, it increased to $11.6 million. But in 2017, it decreased at $96 million. Deferred income taxes is taxes a company will pay in the future due to the discrepancy between the IRS and your accounting methods. It's not that you get a tax refund, it's just money you defer into the future. Without getting too deep into deferred income taxes, now we know the reason why free cash flow was so much less than net income in 2017. Deferred income tax will fix itself over time. It's just a timing issue. If it was something more serious, like a big loss they took, that is something we want to know about. It's great to see that they're investing in their business every year, but you want the return on that investment to be greater than the amount you spent. Let's figure out the discount rate we need to apply to the future cash flows. The interest they pay on their debt is $12 million. That's the interest expense on the income statement. Now we need to know how much debt they have. We'll go to the balance sheet, we'll go to the liability section, Current debt, no current debt. Long-term debt of $293 million, that's debt due after 12 months. They pay a little over 4% interest on their debt. Let's get their effective tax rate. We'll go back to the income statement. The income before tax is $129 million. And the income tax is $32 million. And the cost of debt is 3.15%. Now let's get the beta, because we need to figure out the cost of equity. And the beta is how volatile a stock is relative to the market. And they have a beta of 0.87. So that means a stock moves less than the market. The lower the beta, the less risk and the less volatile a stock is. Now let's go back to the financial statements and get their current assets. Current assets are mainly cash, accounts receivable, and inventory. This is $176 million. And let's get their current liabilities. We need current assets and current liabilities to calculate the current ratio later. The equity is $634 million. That's the value of the company according to the balance sheet. Equity is total assets minus total liabilities. Now we need their EBIT, earnings before interest and taxes. That's $141 million. Now let's look at that capital structure. The cost of debt is 3.15% and they have 32% debt. The cost of equity is 9% and they have 68% equity. And the WACC is 7.15%. And that's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. That's in green here. We get a value of the company of $5.5 billion. We divide that by 25 million shares, and we get an intrinsic stock price of $222. It's trading at $63, so it's trading at a 72% discount. So it's a strong buy according to the model. Let's see what Simply Wall Street values the company at. They're at $242. They're even higher. So this stock is really undervalued. Let's see where the stock has been trading at. It looks like it peaked at around 80, 85 a few months back, but then it dropped. It seems like the company is in a growth mode since they're investing so much in their business, which indicates the stock may go higher in the future, but who knows exactly when. You might have to wait a few years, but it could easily break the 200 barrier. So you can see the expected future free cash flows are a lot higher than the past. The reason that is because I used a really aggressive model that assumed a much higher growth rate. I used that model because of what I read about the company and the expected future growth of the business. And I'll show you how the model works. It's always based off of the prior financial information. I never assume anything else. The aggressive model, I just take the year that had the most growth. In order to calculate the 2020 revenue, I took the 2019 actual revenue, so it's a $580 million. And then I assumed the largest growth year, which was 12.6%, which is the growth from 2018 to 2019. So 1 plus 12.6%, and that comes out to $642 million. Calculate the 2021 revenue, I took the 2020 revenue times the 12.6% growth. To calculate the 2020 net income of $214 million, I took the 2020 revenue, $642 million, times the greatest net profit margin, which was 33% in 2017. And that's $214 million. To get the net profit margin is just net income over revenue. And for 2021, 22, and 23, I did the same thing. I took the revenue times the 33% net profit margin. And to calculate the free cash flow for 2020, I just took the net income for 2020 times the greatest free cash flow of net income, which was 136% in 2016. And that's how I got the $292 million. And I did the same thing for 2021, 22, and 23. I took the net income times the 136%. Let's look at the financial ratios to get more information. They have a decent PE, a decent price of sales, and a good price to book. So PE is stock price over earnings per share. And to get earnings per share, it's net income over shares outstanding. And this indicates investors are willing to pay $16 for $1 of earnings. Price to sales ratio, stock price over sales per share. To get sales per share, it's revenue over shares outstanding. And a ratio of 2.7 indicates investors are willing to pay $2.70 for $1 of sales. I like to see below 2.5 for this ratio. The lower the better for these three ratios. The price to book is stock price over book value per share. To get book value per share, it's equity over shares outstanding. 2.4 indicates investors are willing to pay $2.40 for $1 book value. I like to see below 3.5 in this ratio, so 2.4 is pretty good. Current ratio 1.6, which is good. ROE of 15%, which is decent. So current ratio is current assets, $176 million over current liabilities, so they can cover their current liabilities, which is great. ROE is net income over equity, which is $97 million over $634 million. That's 15%. That means they're providing their equity holders a 15% return, which is pretty good. I like to see 20%. They have interest coverage ratio of 11.5, which is EBIT, $141 million over interest expense of $12 million. So they can easily cover their interest payments. This company seems to have a really bright future if they continue growing and investing in their business. Thanks for watching the video.